Hey guys, welcome you. Myself Nikun. In this video, we will be covering the topic impact on the financial service sector COVID-19. Coronavirus of COVID-19 is a family of viruses that cause a range of illness in humans, including the common cough and cold and more serve from like SARS and MERS, which are life-threatening with the increase of COVID-19 cases, and that worldwide the WHO declared the virus outbreak of pandemic in the second week of March 2020. So due to any kind of pandemic, the global market tracks sharply. Thus, this was no exception. Indian market to come to selling pressure and Nifty declined 35% during the recent collection. The next impact on banks. Impact on bank. The Reserve Bank of India has taken certain measures to give some relief to the leading institutions in the areas of liquidity, regulation and supervision and financial markets. The following are some of the business and accounting considerations for banks. The next one is credit risk assessment. The RBI has given certain waivers to the borrowers, which include moratorium to pay principal and interest with relaxation on their classification as a non-performing asset or a restructured assets. The RBI has given certain waivers to the borrower, which include moratorium to pay principal and interest with relaxation on their classification as a non-performing asset or a restructured assets. This has been implemented to help borrowers tide over temporary financial difficulties. However, banks will have to identify and monitor the borrowers who are facing temporary and long-term financial difficulties. Such borrowers will be provisioned accordingly. Due to the pandemic, it might become to so difficult bank to determine the extent and adequacy of collaterals available with them and the subsequent provisioning. There may be additional disclosure required in the financial statement and the computation of capital adequacy for COVID-19. Banks would therefore be required to maintain risk management function and track their borrowers individually to determine and segregate the permanent impact from the temporary impact and make appropriate provisions. We have mentioned below some of the key areas that meant consideration. The next one is liquidity. Given the situation of the lockdown in the country, the default may have increased substantially as many companies would have lost revenue for a long time. An increase in defaults is likely to cause issue in liquidity and capital adequacy. Auction of targeted long-term repos operation of up to 3 years tenure of appropriate size at a floating rate linked to the policy repo rate to be deployed in investment grade, corporate bonds, commercial papers, and non convertible debentures. Over the above the outstanding level of their investment, these bonds as on 27 March 2020, 50% from primary market issued and 50% from secondary market, including from mutual fund and non-banking financial companies. Reduction of cash reserve ratio of all banks by 100 basis point of 3% of the net demand and time liabilities with effect from the reporting front net becoming 28th of March 2020. This dispensation is available for a period of 1 year ending on 26 March 2021 and will release liquidity symmetrically be benefiting banks the requirement of minimum daily CRR balance. Maintenance has been reduced from 90% to 80% effective from the first day of the reporting fortnight, becoming 28th of March. This one-time dispensation is available up to 26 June 2020. Under the marginal standing facility, has permitted bank to borrow overnight at their discretion by dipping up to 2% into the statutory liquidity ratio. This limit has been increased to 3% with immediate effect. This measure will be applicable up to 30th June 2020. The central bank has widened the existing policy rate corridor from 50 bps to 65 bps. Under the new corridor, the reserve repo rate under the liquidity adjustment facility will be 40 basis point lower than the policy repo rate. The MSF rate will continue to be 25 BPS above the policy repo rate. Further consequent upon the widening of the LF corridor, the reverse repo rate under the LF stand reduced 90 basis point of 4.0. The widening of the corridor between the reference rate is expected to ease short-term volatility and bring stability to money market. Policy repo rate has also been reduced under the LF from 5.15% to 4.40% with immediate effect. Accordingly, the MSF rate and bank rate to stand reduced from 5.40% to 4.65%. The reduced minimum daily cash reserve ratio maintenance to 80% will allow bank to use excess money in the certain days. However, aggregate CRR will be have to maintain on the overall basis. Accordingly to the bank required to have adequate process in the ensure that excess funds are usually only for short-term purpose so as to maintain the overall CRR. The next one is impact on NBFCs. NBFCs would face similar challenges like bank of the asset side. However, maintaining liquidity and capital will be a greater challenge from them. Some of the large NBFCs will need to create provision as per India as which require provision to be compound based on the expected credit losses. It means they would need to compute provision based on losses expected in the future years. Normally, lenders use the past history of default and losses of compute the expected credit losses and adjust them from the future based on their trends with the macroeconomic factor. Since the Covid-19 sort of impact is unpredictable, it will be very difficult from them to compute and expect credit losses. Many regulators in India, the abroad have issued guidance asking the lenders to take a longer term view rather than a short term view while computing the provisions. Further, some of the NBFCs give loans to small business for which repayments cannot be estimated. In this situation, there will be higher losses. NBFCs which have robust collection system, however, might perform better than the payers. Also, the provision will depend on the areas where the NBFCs have been lending from. For example, operating in a relatively less affected area would have lesser provision and vice versa. Then next one, value and price. As India 113 fair value measurement specifies the measurement date exit price estimated based on assumption that market participant will make under current market conditions. The first quarter of 2020 has seen increasing market volatility on the basis of there are still quoted prices in an active market or are still observable. The increase in volatility should not change the way fair value is measured at the measurement date. In level 3, unobservable input are significant to the measurement as a whole. Incorporating such increase in volatility into valuation model may pose challenges of reporting, and that is when making critical assessment and judgment for measuring fair value. The entity should consider was condition and corresponding assumption were known as market participant. While volatility in the financial market may suggest the prices and abbreviation and do not reflect the fair value, it would not be appropriate for an entity disregard market price at the measurement date unless those prices are from transactions that are not already. The concept of an orderly transaction is intended to distinguish fair value measurement from the price in a distressed sale of forced liquidation. The intent is convey the current value of the asset liability to the measurement date, not its potential value at a future date. The next one is impact on insurance. The Covid-19 and the related lockdown would impact the general insurance companies much more than life insurance companies. Broad impact in the expected as follows. First, there would be a fall in the premium income, particularly in motor loans, as the new car sales have stopped due to the lockdown. However, the claims are also expected to be lower. If the pandemic goes on for longer, there would be higher mechanical resulting into the higher cost. there would be a constant on capital rising and liquidity of the parent would be under stress. On the life insurance side, there could be higher claims and the actual assumption could undergo change to the in actual experience. On an overall basis, entity in the financial service industry would be under stress. However, they should work cautiously and look for opportunities to grow strong risk management process, robot collection policies, effect cost control measures, increased use of technology would help entities in the financial service to pass through these testing times. Till the time there is no solution from the coronavirus in terms of a vaccine and antidote, we will have to live with the issue, practice social distancing and carry of business to achieve the desired result. The next one is mortality claims. Life and health insurers, while evaluating in the impact of COVID-19 on their claims, may consider alternative scenarios that would have led to the spread of the pandemic. This may vary from short-term outbreaks to medium-term pandemic and long-term pandemic. Health insurance also need to factor in the capacity of the Indian healthcare system and the effectiveness of action taken by the government. The next one is a loss of profit clause. With a few companies may claims under the loss of profit clause in their insurance contract. This typically covers loss due to the factory shutdowns when unforeseen circumstances such as fire accident occur. Many companies had taken insurance policies to cover losses arising due to the certain unforeseen circumstances, but it is uncertain whether they will be covered for coronavirus under such policies. The next one is financial and cash flow impact. All insurance include reinsurers in India will need to evaluate the pandemic impact on their financial statement and cash flow. This includes on the asset side, how will rating the expected loss in the debt portfolio be affected? What is the likely range of monetary policy responses from RBI and how will this affect short-term yields? Will evaluating market condition, for example, possible contraction will be issuance by trading volume, make it feasible to excuse and effective reinvestment trusted. However, duration matching asset the liability management objective to be met amid market uncertainty. On the liability side, what will the impact on the stretch healthcare system of mortality, which include death due to COVID-19 and otherwise, how you will get health, economic and social impact of the pandemic affect lapse rates. Broadly, all insurers need to analyze financial of operational risk and their impact on the cost of capital under different economic scenario, wise deflationary condition, economic downturn or stagflation. Accordingly, these insurers need to define the triggers for remedial management action under each of these scenarios. So that's it for this video. Thank you for watching वीडियो अच्छा लगने में जरूर प्लीज सब्सक्राइब करें चैनल को, इस वीडियो को भी लाइक और शेयर करें और कमेंट करके अपना रिव्यू दे किस तरह का आपको ये वीडियो लगा. थैंक यू. स्टे सेफ.